It's great to be here. Thank you for coming out this morning on a Saturday. We've had a really, really powerful rally in the market off the bottoms, the lows we saw in March of 2009. And at least for me, I was kind of surprised at how fast the market snapped back. Because after all, we went through the greatest financial collapse, at least in my lifetime. But I guess in retrospect, I really shouldn't be so surprised. Because after all, the US government did everything in its power to engineer a recovery. They are spending money like it's going out of style. The deficit to GDP is over 10% and growing all the time. This is far greater than Canada ever had in its time when it got itself into a little bit of financial trouble. The debt to GDP is over 100% at the federal level. The Fed has tripled its balance sheet, mainly exchanging pristine treasuries for toxic sludge that was on Citigroup's balance sheet. So it's not just the US, though, where we see these issues, where government has ridden in to engineer a recovery. We see this in Europe, and this is starting to make, again, front page news. And we're talking about the PIGS. This is the acronym for Portugal, Italy, Ireland, Greece, and Spain. And Greece has already gone through this, where they've received a bailout from the IMF, the International Monetary Fund. And now there's some concern with Ireland whether it'll be able to float its bonds, and the governments are having trouble financing itself. So it's a bad situation when governments can't finance their own activities, or they have to go to the capital markets and pay an awful lot more than they would otherwise have if they had good books. One of the really great things about my job is I get to travel. And I often get to travel to places like New York City. And, I've got to be honest, when I go there, it feels exactly like it did before. People are still out spending money. The restaurants are full. There's that buzz, that excitement. All the things that we love about New York is still that way. But probably like many of you, by the end of a long Canadian winter, I've pretty much had it. So this year, I went down to Miami to take a week and relax. And it was kind of an eye-opener because I hadn't been to Miami for, 12 or 15 years. And it was really noticeable how many people were opening the door for you at the hotel, 2 or 3 people taking your order or serving your meal at breakfast or lunch. The cab drivers were all complaining about how bad the economy was and how impacted their business had become. And I guess I didn't, think of it until later, but it's been quite obvious. This financial collapse that we've been through in the last couple of years collectively started with a real estate bubble. It dragged in all the financial firms that were structuring product around it. And whether we're talking about the United States or Europe, it was really the Sun Belt areas, the Californias, the Nevadas, the Floridas, that were most impacted. And then similarly, over in Europe, the Spain, the Portugals, and the Italys, where the bubble was the biggest, and the repercussions were the greatest. This was not a normal recession that we went through. And the recovery is going to be anything but normal. And I think you need to understand that right off the bat, that this is going to be a non-normal recovery. Some professors have studied financial collapses, and they've determined that generally after financial collapse, it takes around 6 years for the stock market to make a full recovery, and over 8 to 9 years for the housing market to recover. Now, in the US, we've started to see the housing market stop dropping, but it's anything but recovered. Just consider what's happened in the last decade in the stock market for American investors. The decade that started in 2000 and ended in 2009 was the worst decade on record, the worst in 200 years, including the span that included the financial collapse. You would have been better off if you had invested in soybeans, if you had bought land. Would have been better doing just about anything with your money. Even stuffing it under your mattress would have been a better financial move than investing in the so-called blue chip S&P 500, because that index is down 24% in that 10-year period. So it's been a tough time and will likely continue to be a tough time in the US. If you have investments in the US, If you're one of the Americans who has investment income still coming in, you're lucky, because 7.7 million Americans have lost their job since the start of this collapse. And I don't think many of these jobs are coming back anytime soon. After all, the unemployment rate in the US officially is 10%, and many people think that the unofficial rate is somewhere between 15 and 20%. And that's because there's many people who've been up looking, who are working part-time but would really like to work full-time, are self-employed but really not making any money, but they just can't find a job in the real economy. The one statistic that I came over that I thought was absolutely fascinating is that since 2007, so for the last 3 years, there's only been one age cohort in America that's gained jobs. And those are the people 55 years and older. So why are the older demographic gaining jobs when everyone else is losing jobs? So I have a theory, I think it's right. Those people were banking on their homes to fund their retirement. This is my theory. They bought the McMansions, the super monster homes. They figured they were going to lever themselves up, they were going to add all the toys into the house, and then some other sucker would come along and buy it from them at a big healthy premium, and they'd be retired. And many of them probably were retired in their early 50s. They saw this unbelievable can't-lose bet in real estate, and they went for it. Well, now they can't sell their house. They can't sell it for any price, let alone what they paid for it. So now they're being forced back into the workforce, and it's going to be tough. This was a real estate collapse at first, and then it was later a Wall Street collapse and a financial collapse. Two of the agencies in the US, Fannie Mae and Freddie Mac, these were the companies that were helping the average American get into homes. They guaranteed over $5.1 trillion of American mortgages. They're implicitly backed by the government of the United States of America. And just in the last 6 months, the debts or the money they owe or their books are out of whack has gone from $150 billion to $400 billion. Now, I don't know how it's grown by $250 billion in just 6 months, but that's what's happening. The state of California is issuing IOUs to its workers when it can't pay. So when you start adding on what the states owe, what the federal government owes in the US, what Freddie and Fannie owe, and forget about Social Security, Medicare, Medicaid, the numbers are starting to approach Greece in the United States. So it will be a tough time in the US. You know, one of the things that I've enjoyed doing over the last few years is writing a couple books. Last year I wrote a book called Shell Shock, How Canadians Can Invest After the Collapse. And there's many benefits to writing a book, but one of the nice side benefits you don't think about when you're doing this is you get to send it off to people that you admire and get a little bit of feedback from them along the way. So one of the people I approached and sent him a book was a guy called John Paulson. Now, I don't know if you're familiar with that name, but he runs a company called Paulson & Company. And Paulson & Company is the largest hedge fund in the world. And he basically sent me back a note saying, you know what? I happen to agree with you. Canada is a great place to invest. And it's not just John Stephenson and John Paulson who think Canada is a great place to invest. Bill Gross, the largest bond manager in the world, someone who runs PIMCO, thinks it's a great place to invest. He's actually calling the end of the bond rally, opening up an equity arm, and it was just in the paper last week, he's moving shop, or part of his shop, to Toronto, and he's going to have a Canadian-focused equity fund. And so this is all flying in the conventional wisdom that we've all been told all our lives, which is, if America catches a cold, well, we catch the flu here. But yet, I'm here telling you, and so are other financial professionals, that Canada is it. Canada is the place to invest. You know, after Shell Shock came out, Scotia Capital published a report, a research report called Why You Want to Own Canada. And the conclusions were similar to my own, but they put some different numbers to it. And they studied the returns of the TSX from 2000 to 2009, and they compared it against the S&P 500. On average, each year, it outperformed the S&P by over 10%. but more importantly, it outperformed the MSCI World and the MSCI Emerging Market. It did so, not only did it outperform, but it did so with less risk. So in other words, Canada is a way to take an indirect play on global growth. And this is what people are finding. That is a very, very exciting way to play global growth while staying right here at home. In fact, all the things you've heard about why Canada is not a great market, why you shouldn't invest here, it's too resource-oriented, hewers of lumber, drawers of water, we're just overly dependent on resources and financials, are exactly the reason you won't own Canada. Because these are the things that are working. Jim Flaherty is running around the world telling everyone how great Canadian banks are, and by comparison, they are. We're not perfect, but we didn't screw up. And that's why we're here today. That's why he's lobbying to get a global regulator for the financial services industry based in Toronto. This is a